Hello and welcome to our webinar. I'm Michael Tegos from Smartkarma, and today I have the pleasure of welcoming Saumya Agarwal, who will give us an overview of the key trends playing out in the Indian banking sector, as well as some of her top picks at the end, so stay tuned for that. A few words about Saumya. She has 12 years of experience analyzing the banking and finance sector from both a credit and equity perspective. Saumya was previously a rating and credit risk assessment analyst at CRISIL, Indian Bank's equity analyst at HSBC Securities, and investment banking analyst at JPMorgan. Saumya, welcome, and thank you very much for being with us today. You have the floor.
Thank you, Michael, and good evening and good afternoon to everyone who's joined in. Hope all of you are keeping safe. 1 year into the pandemic, many of the stress points for banks are easing. Additionally, India is coming out of a brutal second wave and reporting a decline in daily infections. Even the vaccination coverage has ramped up, and as on date, some 200 million people, or 15% of the population, has got at least one dose of the vaccination. So with this background, let's move on to Indian banks and why we believe they are poised for a rebound from here. Now, there are some very encouraging trends which are playing out in the Indian banking sector, which will act as a catalyst for banks. And these are around positive trends in credit and deposit growth, better than expected asset quality, a downward bias on credit costs, and receding COVID risk. Let's look at each of these trends in a bit more detail. Now, one of the key concerns in FY21 was the marked divergence in the credit and deposit growth of banks, which was further aggravated by the COVID pandemic. Now, credit growth was already subdued and it continued to moderate throughout FY21 and ended at around 5% year on year, while deposit growth continued to be robust and increased to around 12% vis-a-vis 7% at the end of FY20. However, FY22 seems to have started on a good note, and the trend seems to be reversing. As per the latest data from RBI for the first week of May, credit growth has actually inched up to 6%, while deposit growth now stands at around 11%, reflecting a slight decline and a slight decline in the gap between these two metrics. Now, this is a very favorable trend, and should it continue, it will have a positive impact on the net interest margin of banks. Moving on, the second important factor is the incremental credit to deposit ratio of banks, which tells us how much of the incremental deposit being mobilized by banks are actually getting deployed as credit. Now, this ratio can be, in fact, be a leading indicator of the potential loan trajectory and is therefore extremely important. This ratio had plummeted to around 30% amid the pandemic, as banks were extremely cautious in lending. However, as per the latest data, it is showing some signs of revival and stood at around 46% in the first week of May. Now, both these trends, diminishing gap between credit and deposit growth and a pickup in the credit to deposit ratio, are very encouraging trends, and should they sustain, it will have a favorable impact on the profitability as well as the loan growth of banks. Moving on, the next positive trend is around asset quality. For this, we analyzed the top 7 banks in India, which account for almost 60% of the banking sector credit. And most of these banks seem to have braved the COVID wave pretty well. So if you look at Axis, ICICI, and SBI, gross NP levels have actually trended lower vis-a-vis FY20. For HDFC Bank, it was largely steady. The only exceptions here were Bandhan Bank and Canara Bank. In case of Bandhan Bank, gross NPA levels increased from around 1.5% to around 7%. But this was due to multiple risk factors specific to it. We'll be discussing it in a bit more detail when we come to Bandhan Bank. But barring it, the overall gross NPA position has been quite favorable. Now, if you go back slightly longer in time, we'll see that gross NPA levels have been on a sustained downtrend and are now below the 4-year average. The only exceptions have been Bandhan Bank as reflected in the green line, or Kotak Mahindra Bank, even though the overall quality of Kotak continues to be largely benign. On an aggregate basis, the gross NPA level for these 7 banks have actually halved to around 4.5% from around 8% in FY18. Now, one of the key worries in FY21 was that banks would see a huge spike in their fresh slippages, given that they were just coming out of the moratorium, then the asset classification freeze was vacated, and so on and so forth. But if you look at the slippages growth year on year, much of the slippages growth has actually been contained. So for Axis and State Bank of India, slippages growth has actually turned negative, while it is positive for all of the banks. However, there have been no unusual spikes, barring Bandhan Bank, about which we'll be talking in detail. On an aggregate basis, slippages as a percentage of opening gross NPAs stood at 36% at the end of FY21, vis-a-vis 41% at the end of FY20. Hence, fresh slippages have actually not spiked as expected. Now, there are a couple of reasons why slippages did not spike. One was obviously the modest credit growth, as banks turned extremely cautious and also tightened their underwriting standards. At the same time, some of them also rebalanced their loan portfolios to drive growth in safer asset classes like mortgages or gold loans. In addition, government measures like the emergency credit line guarantee scheme also helped alleviate the stress of the small borrowers to a large extent. Moving on, banks, however, did resort to sizable write-offs during the year, and that is evident in the case of Axis, SBI, and Canara. Write-offs was largely benign for Kotak and ICICI Bank. Bandhan was an exception because of multiple risk factors specific to it. But on an aggregate basis, if you look at write-offs as a percentage of opening gross NPAs, it was largely in line with the previous year's trends at around 20-21%. Now, a combination of both these factors, lower slippages and accelerated write-offs, will put a downward bias on credit costs going forward. If you look at FY21, most of the banks saw a sizable rise in provisions and contingencies, largely because they provisioned much more than the 10% norm mandated by the RBI on a prudent basis. They also had written off quite a bit, and both these factors led to an increase in the provisions and contingencies expense during the year. But with much of the heavy lifting being completed in FY21, and a downward bias on provisions is highly likely from here. To add to it, banks have built huge COVID buffers, which are over and above your specific provision cover. For the banks under our coverage, the COVID-related buffers stand anywhere between 3% of gross NPAs to around 40% of gross NPAs, thereby providing ample coverage against incremental asset quality stress. So if you look at the gray and the green column on the right-hand side, you see that for these 7 banks on an aggregate basis, the COVID provision stood at around 10% of gross NPAs, quite a sizable amount. Now, in terms of credit costs, we are seeing some very interesting trends, and we have demarcated the banks into 2 sets. So on the left-hand side, we have SBI, Canara, ICICI, and Axis, which have been seeing a sustained downtrend in credit cost, whereas on the right-hand side, we have HDFC, Kotak, and Bandhan, which are seeing a slight upward bias. Now, going forward, this trend in credit cost would be the key differentiator amongst banks. But given that most banks have done heavy provisioning in FY21 and have also built sizable buffers, a downward bias is increasingly likely. Moving on, the next positive trend is around receding uncertainties. If you look at this chart below, the daily trend of COVID cases has been on a decline, even as government is trying to ramp up vaccinations. The target of government is to vaccinate around 500 million people by July-August, and that should further improve the COVID landscape in India. One of the interrelated trends to this have been the FII inflows, which have largely coincided with the peaks and troughs of COVID cases in India. So if you look for the months of January and February 2021, FIIs were net buyers. These were also the months when the COVID cases in India were at the minimum, and FIIs turned net sellers in April and May, undoubtedly the worst months for India with regards to the COVID cases. We expect that this trend should likely reverse going forward as the COVID cases decline, and FII inflows should turn positive. Now, if you look at the last 1 year, the broader markets have risen by around 100% year on year, and the BankX or the broader banking benchmarks have outperformed the broader markets. We believe that this outperformance would likely sustain going forward on the back of positive trends in the banking sector and also the improved FII inflows. Going forward, let's look at the top picks in the Indian banking space. Our top pick is Bandhan Bank. The stock is currently trading at a level of around 300 rupees and has corrected very significantly in a short span of time because of deterioration in asset quality. Now, Bandhan Bank has been affected much more than the other traditional banks because of its focus on the microfinance segment. Microfinance constitutes some 65% of the total loans of Bandhan. Bandhan is the market leader in microfinance in states of Assam and West Bengal. And both these states were in the throes of election frenzy till about a few months ago. So both these factors, the raging COVID wave and the elections, have severely disrupted the cash flows of microcredit borrowers. However, with the elections having concluded and the political situation largely stable and the COVID risk abating, we believe that the asset quality trend should see a marked improvement from here on. Collection efficiency should normalize towards the long-term average, which is around 98 to 99%, and that will provide a positive catalyst to Bandhan Bank. Moving on, our next topic is State Bank of India. The stock is currently trading at around 430 and has run up quite a bit in the last 2-3 months in expectation of a strong Q4 FY21 results. Despite having a giant balance sheet accounting for around 22% of the banking sector loans, State Bank of India has registered a significant improvement in its asset quality. Fresh slippages are down some 40% year on year, and fresh slippages as a percentage of opening gross NPAs now stand at around 24%. Even the overdue loan book for State Bank of India is now below 1% on a sequential quarter basis. And both these factors should act as positive catalyst for State Bank of India. Additionally, SBI's fintech platform YONO is scaling up really well. YONO ended FY21 with a subscriber base of 37 million subscribers, and it has a huge potential to scale in-house, given that SBI has a giant debit card base of 300 million subscribers and also has digital partnerships with Jio, which has an additional 500 million subscribers. So all these trends should act as positive catalyst for SBI, which should see its valuation multiples reviewed from here. Our third top pick is ICICI Bank. The stock has run up quite a bit and is now trading at around 650 levels on the back of a strong retail growth. Now, ICICI Bank is a retail-focused bank, and retail loans constitute around 70% of its total loan portfolio. Now, even amid the pandemic, ICICI Bank had been driving retail growth, but despite that, the retail NPAs have held up pretty well. Additionally, ICICI Bank has also built up huge COVID-related provisions, and total coverage stands at around 100%, which augurs very well for the asset quality of ICICI Bank. We believe that this should act as a positive rating catalyst for ICICI Bank. Moving on, this is the valuation slide, which shows the comparative valuation of our banking stocks vis-a-vis their returns based on the comparative return risk return metric. SBI, Bandhan Bank, and ICICI look extremely attractive. Just to conclude, a combination of bank-specific factors coupled with some of the key trends which are playing out in the banking sector should act as a strong catalyst and help Indian banks stage a rebound. So that's about it from my side. Thank you.
Thank you very much, Soumya. This is a great snapshot into the sector. Maybe I'll kick things off. Soumya, in terms of the incremental credit to deposit ratio picking up, are there any specific sectors, speaking, of course, about retail versus corporate, which could drive this?
So in terms of the credit growth drivers, this would depend largely on the portfolio composition of banks. But if we were to look at the broader trends in FY21, corporate growth was extremely sluggish, given that the corporates had underutilized their working capital limits or deferred their capex plans. In fact, retail growth was quite robust. So was agri and MSME. And MSME had the benefit of the ECLGS scheme from the government. And going into FY22, much of these trends should continue. But as the overall macroeconomic backdrop improves, corporate growth should see a gradual revival from here on.
Understood. Thank you. Anatandi asks if you have any thoughts on AU Bank. I assume that's AU Small Finance Bank?
Yes. So AU Small Finance Bank is actually the largest small finance bank in India, and it's similar to its peers like Bandhan Bank, which are focused on the microfinance segment. AU has a large exposure to the small businesses and self-employed individuals. However, AU's geographic concentration has largely been around the states of Maharashtra and Rajasthan. And despite the ongoing COVID wave, asset quality has held up well. While AU is seeing a stress on its book, but the collection efficiencies should rebound once the COVID situation eases. As is true for all the small borrowers, this segment is the most vulnerable, but is also the first to rebound back. And that should see re-rating for AU Small Finance Bank.
Thank you for that. Another question from the audience is, how much of the Indian bank's recent performance, improvement or otherwise, can be attributed to any relaxation by the RBI?
So I think this is a very important question, Michael, and I think RBI has played a very important role in terms of easing the monetary conditions for banks. At the same time, not just RBI, even a lot of fiscal measures like the ECLGS has played a very important role. Now, if you look at the MSME sector, which is around 12 to 13% of the gross banking sector credit, this has been one of the most impacted amid the COVID. But this government's emergency credit line guarantee scheme has gone a long way in alleviating the stress. And the proof of that lies in the corpus which has been used. So ECLGS had a corpus of around 3 trillion rupees and around 2.5 trillion has already been used. So both these measures definitely are helping borrowers to try to tide over the current stress. And in addition, the favorable trends which we are seeing panning out in the banking sector, a combination of both these should help rein in the asset quality risks for Indian banks.
Thank you for that. Another attendee asks, where do you think loan growth will come from and which segment would drive it, in your opinion?
I think, as I said, much of the trends of FY21 are likely to continue into FY22. And having said that, we will see retail, agri, MSME gradually picking up growth as the COVID situation abates. Corporate growth has been sluggish till now, but that should pick up speed as lockdowns are lifted and much of the restrictions are done away with. Most of the companies have halted the productions, and that should come back to a more normalized level and see a revival in corporate growth as well.
Understood. Thank you. Another question from the audience is, it regards your view on microfinance and retail delinquency, which banks are most exposed. What would be your view on that?
I think that's a very good question. So I think there are two differentiators over here. While when we talk about microfinance, we are seeing the stress panning out, as in the case of Bandhan Bank, which is the leader in the microfinance space. So asset qualities have spiked sharply, collection efficiencies have dipped. But what is giving us a lot of comfort is that microfinance, despite being the most vulnerable, is also one of the most resilient segments. So collection trends should normalize as these small businesses start start getting their cash flows back. So while the stress in microfinance is visible, it should start to ebb from here on. But on the contrary, a very interesting trend is that despite all the claims that retail asset quality will be very stressed, and we see the retail stress coming out. If you look at some of these top 2 3 banks, SBI, ICICI, who are predominant in the retail space and have sizable retail books. Most of these banks have held up the retail asset quality pretty well. So what that means is that till now, the retail gross NPA numbers have largely been benign. And what has helped is that banks have shifted towards secured retail asset classes like mortgages and gold loans, which are kind of shielding the stress. So we believe that because of these trends and rebalancing, retail asset quality should not spike so much, and this will be further aided by the improving COVID landscape in India.
I see. Thank you. Another question from the audience is, which banks, in your opinion, are fairly overvalued at the moment, and why?
If you look at the last 1 year performance, the BankX has run up quite a bit, up around 120% year on year. Now, overvaluation has to be looked in context of the EPS accretion or the book value accretion, which is likely to come in. So I think much of the run up which has happened in the last 1 year has been despite the stress on fundamentals. But now the next rally which will come in, that would be supported by fundamentals. So even though many of the banking stocks have run up, the catalysts from here on are quite strong, and that will support the higher multiples for these banks.
Thank you. Another question, in fact, touches on something that I'm also particularly interested in, and you did mention that a bit during your top picks. Which banks are leading the charge and succeeding in digital banking?
Okay, so in fact, the pandemic has accelerated the digital agenda across all the banks, be it private sector banks or public sector banks. But yes, private sector banks like ICICI, Kotak, and even Yes Bank, despite all the inherent corporate stress, they have had very strong digital capabilities, and they have taken this situation, to further enhance their digital abilities. Having said that, we are very positive on SBI's fintech for the sheer scale and the potential to scale up.
Understood. Thank you. So the government of India recently extended the emergency credit line guarantee scheme to September of 2021. How would that impact loan and the asset quality of banks?
The emergency credit line guaranteed scheme was first introduced in May 2020 to help the MSME borrowers and the self-employed individuals since they are the most impacted by the COVID. And the initial corpus under the scheme has been around 3 trillion rupees. The scheme under the scheme, borrowers who were standard as on 1st March 2020 could draw an additional 20% of their outstanding loans and on an absolutely collateral-free basis, which would be backed by the Government of India. Now, ECLGS has played a very pivotal role, and this scheme has actually been extended in phases. We have had ECLGS 1, 2, 3, and 4, and it has gone a long way in supporting the growth of MSME credit, and has also kind of handheld the small and the MSME borrowers through this tumultuous phase. So I think overall the impact has been quite favorable.
Understood. Thank you. Maybe I'll take a final question from the audience, basically regarding consolidation chances. So the question is, are there any chances of Yes Bank or any other bank basically being sold off like SLB to DBS recently?
The case for consolidation is always there because we do have a couple of very weak public sector banks. But specifically for Yes, I think that's not a possibility because Yes Bank has actually just come out of the worst phase. It has got the life-saving capital injection of around 10,000 crores from the SBI-led consortium last year, and is on a very strong footing. But for the rest, you never know. Definitely, if there are some, potential events like this, consolidation could be a possibility.
Understood. Thank you very much. And thank you very much to everyone for attending today and for all your questions. Please note that Saumya has written extensively on this sector and these names on Smartkarma, so definitely do check out her insights on the platform. Saumya is also available for bespoke research requests, so please contact your Smartkarma account manager if you're interested in that. And if you have any other questions, you can always email us at research@smartkarma.com. Saumya, thank you very much for sharing your time with us today.
Thank you, Michael. Thank you for having me.